Ben, this is a setup here that maybe isn't surprising, given the fact that we've often talked about seasonal positive trends in this time of the year. But is that much dry powder, so to speak, on the sidelines due to come in to the equity markets, or could it go elsewhere? Or could it just stay put with 5% yields on cash balances?
I think you can say all of it, Dom. And you know, there is indeed 5% of money markets that's very attractive to think about from a year ago. But that dry powder, I think, speaks to people willing to take risk. You know, if you have a lot of cash on the sidelines, some buffer, right, it tends to take opportunity when the market goes up. So, and as you're saying, the seasonals are strong. It seemed to be working out like it did in the past. So it becomes a bit self-fulfilling. So I think you can see some of that money market money going into the stock market or bond market, given where we are in current valuations. On the other hand, going into a much different year next year, probably more uncertainty, keeping someone on the sideline.
Let's talk a little bit more about those valuations, because some would argue that the run-up that we've seen over the last few weeks in certain tech stocks, especially the mega cap ones, has made it so that those valuations are no longer as compelling, and that there might be more compelling opportunities in other parts of the market. Do you think that equities are still the place to be? And if so, is it still mega cap tech?
No, it's not all mega cap tech, but it's really about earnings ultimately. You know, if 2024 earnings forecasts were again too rosy, then those valuations don't look good. They look actually out of line. So some of it probably plays a role for people being careful about valuation on mega cap tech. But you can also look at small caps, or you can look at mid caps, you know, where the valuations look more in line with where the forecast is. I think that's where the opportunity is if you believe, and we think, that recession scenario isn't really playing out. And most of the rise in interest rates have now been fully absorbed by, particularly, I think small caps are very sensitive to low interest rate, or to a high interest rate. So I think that's where the valuation opportunity probably is.
The slowdown narrative has been what's been dragging on that small and mid cap trade, that so-called SMID cap trade. If there is a mean reversion element where there's a catch up to be had for those small cap type stocks, just how forceful could it be? Could they catch large caps, or is it something where they catch 25 to 50% of the large cap move, and that's good enough for that mean reversion trade?
I think that's probably the right way to think about it, sort of this 25-50% potential move, because those mega caps are still in, you know, they're the largest ones in the index. You know, that's because of the index flows, plus people still flock to those out of, you know, safety and familiarity and profitability reasons. But what we're really talking about here is the economy itself. We're coming up from a very hot quarter, have slowed down a bit, but we could re-accelerate again. The retail sales data is showing from Black Friday, as we were talking before, into today, is showing really good numbers. So I think the economy is maybe up for another acceleration. That, I think, drives that small cap mean reversion. Let's say 25%.
Speaking of the safety trade, it's often been government bonds, specifically the U.S. side of things. We've seen a massive buying effort made in government bonds on the long end of things that have pushed interest rates significantly below the 5% that we saw at the cycle highs this time around. And at the same time, we're seeing an acceleration in retail sales data, perhaps less of a recession risk on the horizon. Where is that government bond trade in your mind? Has it played out, or is there still opportunity there?
It's a bit of a tricky one, because we also deal with this fiscal deficit and supply that has been a bit in the background now, and that could come back because, again, we're borrowing a lot of money, right, for including next year. That has been an issue over the last summer, that we had supply issues plaguing the treasury market. On the other hand, it's just the economy in itself. I think the acceleration that we went through, cooling off a bit and re-accelerate potentially, keeps those yield levels high. So don't be surprised to see the 10-year going back to 5%, even that we're getting messages from the Fed that they're done, as they say.